Hello everyone. Are small cap stocks going to outperform, and what does it mean to you? Let's first take a look at Tom Lee's latest interview regarding the topic.
I think the rally that started last week for small caps is going to be larger than the October to December rally of last year. That was over 8 weeks, almost a 30% gain for the Russell 2000. This time we have a larger short position by institutions. We have small caps even more oversold. And valuations, whether you look at median PE, which is now at 10 times 2025 earnings, even lower. So we think that this move could be something like 10 weeks and as much as 40%. So I think it is just starting. And a lot of it has to do with the fact that, the June CPI was so astonishingly soft. I think it's giving the green light for small caps to rally finally because the Fed will, ultimately cut, hopefully by September.
And how much do you expect the S&P to potentially rise over that same 10 weeks?
That's a good question. I think July, our base case remains that July should be good for the S&P 500. So, something like 57, maybe even close to 5,800 in July. But I think that August is really going to be one where the rotation becomes more evident, and I think it's going to be a stronger small cap and maybe flat to slightly down for the S&P.
Okay, and so that's what I was getting at is how strong can the small cap, say the Russell 2000 as a proxy, be versus the S&P 500? And you're saying after July, you actually think that there's going to be a significant outperformance of small caps versus that index?
Yes, and that's kind of what happened in that October to December rally. That, as you know, the large caps actually really sputtered in late December and early January because of that rotation into small caps. And I think, again, because the positioning is even more short relative to large caps, that it could be an even more sizable move.
In the video, Tom Lee said in 2024, he believes small cap can go up to 50% gain. And this chart is Russell 2000 representing the small cap space of the U.S. stock market. As we can see, year to date, 2024, it's up about 12.7%, meaning there's still a lot of room to go. And in the video, Tom Lee also said throughout the year, the gain could happen within a short span of 10 weeks, where 40% of gain can happen to the small caps. Tom Lee also mentioned that the reason why small cap will outperform is due to a surprise of the CPI report. He mentioned it as the green light of CPI because in the latest June CPI, as we can see, both the headline and core CPI were lower than expected, both on the yearly and the monthly basis. Also, recently, we can see a Russell 2000 breakout towards the upside. This chart shows you black Russell 2000 breaking out over here versus the red 2-year Treasury bond yield. They're going the opposite direction. One is the majority of the rotation into small cap will happen. According to Tom Lee's video, he said the rotation will most likely happen in August, where small cap will noticeably outperform the large caps. And it will be larger. The gain of the small caps during that period will be larger than what happened last year from October to December. So this chart shows you Russell 2000 from last year, 2023, October to December. We saw a gain of about 27%, and Tom Lee believe starting about next month, right in August, we're going to see a gain much larger than that and even longer than that, because I took a look at FundStrat's notes to the client. This is what they said in the notes. They said, because today we're actually seeing expected to see an actual rate cut by the Federal Reserve. Last year, there was no rate cut. So because of the additional rate cut compared to last year, this time the rally should be larger and longer. In the video, Tom Lee also mentioned about regional bank sentiment improvement. And right now you're seeing a chart of KRE ETF. KRE is the SPDR S&P Regional Bank ETF, the most popular regional bank ETF. And this ETF is up 22% from June, right? From June 14th until today. So it has just broken out to the upside, towards the upside, just like the Russell 2000. And why is regional bank so important for the small cap? Because regional bank is about approximately 50% weight of the Russell 2000 index. In the note that Tom Lee sent to his client, he also mentioned that the current investor inflation expectations are too high, and when they turn lower, they will provide fuel for the small cap stocks. So currently, as you can see, this is the 10-year Treasury bond yield. This thing is at 4.2%. It's way higher than the peak of 3.2% observed in 2018, right? So he's pretty much saying the lower inflation expectation, which will happen in a bit, will lead to lower interest rate. In this case, we're looking at long-term interest rate, right? Which will reduce the borrowing cost of companies, which will be beneficial for small cap stocks due to their reliance on borrowing to fund their growth. And if we look at the situation on a big picture angle, we can see that currently we are experiencing the longest stretch of small cap underperformance since the inception of Russell 2000 index. Usually small caps do better when Federal Reserve cut interest rate. So this chart on the top, I try to line the top one and bottom one up. So bottom one is Fed funds rate. Top one is interesting, show you the Russell 2000, which is small cap index, versus Russell 1000, which is a large cap index. And this shows you the difference of them. So when the value is above the zero line, it means the small cap is actually outperforming the large cap. When the difference is below zero, meaning large cap is actually outperforming the small caps. And as we can see, we saw a 5-year stretch over here. That's about 1994 to 1999. In those 5 years, small caps were underperforming 5 consecutive years. But then 10 years later, we're seeing 8 out of the 10 years are pretty much outperforming, right? And right now we're in another long stretch of many years of small caps underperforming the large caps. So maybe it means that based on the cycle, right? Everything has a cycle. We should in the future, maybe this year, maybe later, but it cannot be underperforming forever. At a certain point, small cap will do better than large cap. And if you look at the bottom, right, the Fed funds rate, when small cap outperform large caps, that's when Federal Reserve usually are having, or right after the beginning of a rate cut cycle, right? We can see that 1990 to 1992 until 1994, this period, they kind of line up. And then during this outperformance, that's about the rate cut of dot-com bubble, right? And then after the 2008, we do see a year of very good outperformance of small cap. But what's interesting is in 2020, the pandemic, it's actually within the long stretch of the underperformance. I think the reason why 2020 rate cut didn't help the small cap is because of the pandemic. There was a lockdown, right? So during the lockdown, a lot of foot traffic are gone, and only large caps with resilient business models are benefited, and small caps were suffering during this special period. And according to Jefferies, during the first year following the start of a rate cut cycle, small caps has risen on average 28% compared to just 15% for large caps. So I'm going to share my opinions on this situation. Number one, the outperformance of small cap is based on the assumption that inflation will continue to cool down and the Federal Reserve will cut interest rate aggressively as expected by the market. Right now, the market is expecting 3 cuts this year. So only if these factors can play out, I do think small cap stocks will be more than likely to outperform the large caps. And number 2 is, if you decide to make a bet on the small caps, it's very important to be aware of the risks, right? Like the factors I mentioned, there is a possibility that they don't play out, and you should only allocate an appropriate portion of your portfolio into this. And unexpected economic data, geopolitical events can lead to a Federal Reserve adjusting its course on monetary policy. So I personally think a balanced approach is more appropriate for long-term investors. Thank you very much. Please don't forget to subscribe.